The next construction is time spread, but I prefer calling it a calendar option spread because it consists of options which expire at the different times. The value, profit loss, can't be determined until both contracts expire. The value also depends on what will happen between the time of short-term contract expiration and long-term contract expiration. That's why I consider not to play guess game and close both contracts a few days before first expiration. There are many variations of what contracts strikes to trade to make a time spread, but we are talking about delta neutral strategies. That's why I'm telling you about trading both contracts with the same delta. This is my favorite construction, and it helps to earn small money but with very limited risk. You should sell a near-term option which is closer to the current price and buy a long-term option of the same type and the same delta. I kindly advise you to trade call options because of the feature of agricultural markets. This strategy has positive vigor, and if volatility rises, strategy value increases. As I told you before, when agricultural markets goes down, implied volatility usually decreases, and when up, increases. This is true for many markets: corn, wheat, soybeans, sugar, cocoa, and coffee, because upside movements on these markets are connected with weather issues or any supply disruptions. And traders often overestimate the problem and push the market higher than needed. While they have strong expectations about the problem to grow, implied volatility also increases. Let's make it clear using this chart. This is a long call time spread. You are short on coal for 110 on September futures of corn, but this option expires in August, and long on coal for 125 on September futures on corn. I call it long call time spread because you have to pay a premium what means to buy. As you can see, delta is approximately zero, while vigor is positive and theta is slightly positive. It means that time plays into your hand, and you are waiting for implied volatility to increase. Thus, you earn money if the market goes higher, or stay here, but you have to lose your paid premium if the market goes down. Actually, it's not clear from the chart, but don't worry about upside movement. As I said, volatility will increase in that case, and your total option value rise. Here you see that break-even is near 375 cents. After 2 weeks passed and volatility increased by 10%, break-even is near 435 cents. Break-even always shifts higher if volatility rises. It means that whenever the market goes up, you would never end up in a bad position. Let's list all advantages and disadvantages of this time spread on calls. Advantages: limited risk, unlimited profit in case of high volatility and upside price movement, positive time decay, you earn if the market trades sideways or rise, positive vigor, your value increases if volatility would rise, and the only disadvantage is that this is a debit construction. You have to pay premium. When to use this construction? In case of low volatility, for example, if you are waiting for volatility to increase. If the market reaches its local low, but you are sure that it should trade sideways near support levels, and it's better to use it during summer when there is a high risk of crop to be damaged by bad weather. For winter wheat, it's September and March because of risk of freezing in the United States. For coffee, January and February. For cotton, during the first 2-3 months of the year when farmers take decision about the acreage size. Actually, you can use this strategy whenever you want, if only you are waiting the market to go upside. What markets to trade? Coffee. This market is very sensitive to bad weather development because because at least half of world coffee production is concentrated in Brazil. Cocoa. Two-thirds of world production are growing in Ivory Coast and Ghana. This market could unpredictably increase during the summer, when there are a lot of expectations of bad weather to damage the main crop. Corn, wheat, and soybeans. Corn is more local market than wheat and soy. Thus, any weather issues or even World Agricultural Supply and Demand Estimates report could drive the market higher. Grain stocks report also is important for the market. This strategy is very, very helpful, and I have many profitable trades as a result of it. It's a perfect choice for beginners due to limited risk and no need to adjust.